From a young age, you are taught to value a single three-digit number. It acts as a gatekeeper for your most fundamental life choices, from where you live to what you drive. Society frames this number as a report card for your character. We are told that a high score is the ultimate proof of financial health and personal responsibility. In practice, maintaining that responsible status often looks like this: a wallet packed with multiple lines of credit, each requiring constant management and a steady stream of transactions. Chasing a higher score locks you into a cycle of constant borrowing. Ultimately, the number reflects your debt capacity, a measurement of how much money you can manage for the bank without defaulting. This wasn't always the standard. Before 1989, local lending relied on human assessment. Bankers looked at your actual cash reserves and your reputation in the community to determine if you were trustworthy. The FICO algorithm replaced that human judgment with a standardized mathematical system. Your financial identity was compressed into an opaque formula you couldn't see or influence. This creates a strange paradox. A consumer who pays cash is viewed as a risk, while someone managing 5 credit cards is an ideal candidate. The algorithm favors borrowers because they provide data. Avoid debt entirely and you become a ghost to the system. The system treats financial independence as a flaw. Because a self-sufficient consumer doesn't generate interest payments or transaction fees, they cannot be monetized by the bank. To understand the system, we have to look at what the algorithm considers an ideal product. An 800 score borrower is the bank's most valuable asset. They use the bank's money frequently, they follow the rules, and most importantly, they pay their bills on time. The mechanics are simple. Every transaction and interest charge is a direct transfer of wealth to the bank's profit margin. When you use cash, you sever that link. You remove yourself from their revenue stream, providing them no way to profit. This confirms that credit scores are effectively a profitability index. They are designed to identify the customers who will generate the most reliable revenue for the financial institution. Most financial advice highlights the credit utilization rule. You are told to use your credit, but ensure your balances never exceed 30% of your total limit. This recommendation functions as a psychological nudge. It conditions you to feel comfortable leaving a balance on your cards rather than clearing them entirely. There is a mathematical cost. Even at 30%, the remaining balance generates compound interest, allowing debt to grow silently. If you pay your balance to zero, the algorithm penalizes you. It interprets a lack of debt as a lack of data, dropping your score. This creates a loop where you find yourself checking credit apps daily, anxious that a responsible choice will trigger a score drop. You stay in debt simply to protect your status. Real financial health comes from liquidity, not an algorithm. Your bank account's growth is a far more reliable indicator of freedom than a score that requires you to stay in debt. There are, of course, times when participating in this system is a practical necessity. For most people, a credit score is only relevant when they need to secure a mortgage. In this scenario, the score simply determines the interest rate, the literal cost of borrowing the bank's money. This reliance on borrowing has turned basic transportation into a long-term debt obligation, where the deal is defined by the monthly payment rather than the total price. To get the best rates, you don't need a perfect 850. Once your score passes the 740 threshold, you generally qualify for the same optimal interest rates as someone with a perfect record. Once you pass that threshold, an 850 offers the same financial benefits as a 740. Obsessing over those final points drains your focus without providing any real-world savings. The ultimate goal of personal finance is to reach a point where you no longer need the bank's permission to make a purchase. You build this freedom by prioritizing liquid cash and emergency funds. When you have the capital to pay for your own life, a credit limit becomes irrelevant. Possessing your own capital neutralizes the bank's power. You stop being a source of revenue for them and start being the owner of your own future. Mastering your money and building real assets frees you from the corporate algorithm. You stop playing the bank's game and start winning your own.